the exciting fireside chat, I request the guests to please stay tuned for the second and final panel discussion on the theme Role of Critical Investing in Clean Energy Startups, Investors' Perspective. The panel will be moderated by Manoj, the founder and CEO of Social Alpha. As already shared, Manoj is the captain of our ship and is the driving force behind the team. Now we will invite all the panelists. Mr. Simon Bennet, Energy Analyst, International Energy Agency. Mr. Bennet has a decade of international experience working on technical and policy aspects of energy. In his current capacity, he works on economic and investment issues within the IEA Executive Office. Mr. Bennet is also responsible for demand side topics and new technology segments. Welcome, Mr. Bennet. Our next panelist is Mr. Karthik Chandrasekar, founder Sangam Ventures. Sangam Ventures is a seed and early stage venture fund that invests to improve access to sustainable energy and resource productivity solutions for the underserved in India that can lead to inclusive development and creation of communities that are resilient to climate change. Our next panelist is Ms. Anjali Bansal, founder Avaana Capital. Avaana Capital invests in and provides scaling up support to innovation-led startups for catalyzing impact at scale while delivering commercial returns. Ms. Bansal has invested in and mentored various successful startups, including Delivery, Urban Clap, Nika, and Lenscut. She is closely associated with Niti Aayog's Women Entrepreneurship Platform, Digital Solutions, and is a mentor to the Atal Innovation Mission. Our next panelist is Ms. Padmaja Ruparel, co-founder and president, India Angel Networks. Indian Angel Network is India's first and now possibly one of the world's largest group of business angels, comprising the who's who of successful entrepreneurs and dynamic CEOs from India and overseas. Ms. Ruparel built IAN from inception, making it within 15 years a unique institutional globally, with close to 500 investors across 10 countries and a portfolio of more than 160 companies in 7 countries, spanning 17 sectors. Our next panelist is Mr. Avishek Gupta, Investment Director and Head, Caspian Debt. Caspian Debt has funded over 150 early and growth stage social enterprises and startups across multiple sectors. Mr. Gupta is also a trustee of Dwara Trust and a Thai charter member. Prior to Caspian, Mr. Gupta helped set up a wholesale structured finance business in small business lending and affordable housing finance sectors. Mr. Gupta holds a BTech in dairy technology and MSc dairy chemistry. He also holds a postgraduate diploma in rural management from Institute of Rural Management, Anand. We will start the panel with an introductory presentation on global early stage investment trends in the context of clean energy challenges by Mr. Simon Bennet. Over to you, Mr. Bennet.
Thank you very much, Nikita, for the very kind introduction, and hello to everybody who's watching today. It's a great pleasure for the IEA to be invited to speak alongside many distinguished guests today and to speak in this panel on investors. You might reasonably be asking why the IEA is speaking in a panel on investors. I'm not an investor. I don't have the courage of my fellow panelists here today, but I would just like to take a moment to perhaps set the context for today's discussion, in addition to some of the great words that we've heard from the entrepreneurs and other speakers today. And I'd like to do that in 3 ways. Firstly, to just talk about a little bit about where we are in the energy system today and the scale of the challenge ahead of us, and just remind the investors that they are doing something terrifically important. Also to give a little overview of some of the trends that the IEA is seeing in this space. We've actually published just this morning our latest analysis on venture capital trends in clean energy, which you can find on our website. If you go to iea.org and you follow the link to innovation, you will find that, that new analysis sitting there. And thirdly, just a quick word on some of the reasons for caution and in terms of the current trends, and why we need renewed effort, and why we need also, I think, government support and initiatives like the Techtonic one. So let me start quickly with the overview of just how special this moment is in time right now. Last year in the summer, we did some analysis that we released where we looked at what it would take to get to net zero emissions globally in terms of the innovations and the technologies. And what we discovered when we looked especially at some of the sectors where it's more difficult to reduce emissions, like long distance transport and industry and things, we found that around 35% of the cumulative CO2 emissions that would be needed to reach that net zero target would actually be needing to come from technologies that are not got past the demonstration stage today. And so that's over a third of the emissions reductions. It's a huge slice of the challenge that isn't actually on the market. So that's how important innovation is. And then since then, we've seen so many countries and companies just increase the number of announcements in terms of trying to hit that same target of net zero. And that includes obviously China, Japan, Korea, but many others, and companies, you know, including Tata, who we just heard from, which is fantastic. And we've been tracking the numbers across the energy system, and things are already moving in that direction. We've seen the electric vehicle sales across the first 11 months of 2020 were actually up around 50% against people's expectations. There was a 4% rise in renewables investments up to October 2020 in terms of the installations. So there's this sort of robustness in the clean energy sector that shows that the market is shifting in this direction. But in order to get the policy change that needs to bring the technologies through, what we know is that having a robust local innovation system, local technologies, can really help policymakers to put in place the right supportive measures. And we released our India Energy Outlook just last week, and in that there's some numbers that I think indicate you know, what the opportunity is here for Indian technologies to take advantage of this growing market opportunity and to implement it. When we looked at our scenario that shows evolution under current existing policies, we found that by 2040, you know, 1 in every $7 around the world that are spent on things like solar, wind turbines, and batteries would actually be spent in India. It becomes the biggest market for most of those technologies. And when you move from that sort of undercurrent policies scenario, which has around $40 billion of investment in 2040 in those technology areas, that doubles to $80 billion in a scenario in which the world meets the Paris Agreement and other sustainable development goals. And this is a global challenge. So that opportunity in India is then linked up with the opportunities in other parts of the world, and we need the capital and the innovation to flow across borders in order to make that happen. So what's happening when we look at this high level situation in terms of the deal flow in 2020? Well, we've had some surprises, in fact, when we started to crunch the numbers, because at the start of the pandemic, when we did some analysis in April and May last year, we were quite worried. We thought that the doing business environment for venture capital, the uncertainty about the future, and the potential sort of economic constraints on capital availability would cause a significant contraction in the market. And actually, the result has been pretty robust. From a $4.4 billion market in 2019 for early stage venture capital in clean energy, we've seen a 30% drop in 2020 to 3.1 billion. But the way that I tend to look at this is that 3.1 billion is still higher than any year since 2011, since the last major clean tech bust, boom and bust. So we're still in a significant growth phase, but the this sort of dent in momentum in 2020 is something that we need to come out of relatively quickly if we're going to have the technologies available in order to meet some of these longer term challenges. When we start to unpick what is going on in the regional level and the different technology areas, we see a few reasons for caution and a few areas for action. One is that the early stage deals, which I was referring to, actually fared worse in 2020 than later stage deals. So later stage deals that are supporting companies that have products on the market or perhaps more mature, perhaps offer a lower risk investment. Those attracted more capital, or at least their trends were stronger than the early stage stuff, which tends to be a little bit more radical. It tends to be higher risk. It tends to be the type of innovations that might lead to more systemic change. And when we look at the early stage deals in particular, we see that things like transport, electric vehicle charging are doing very well still through the pandemic. But what's happened is a shift in these sectors and in the electricity sector and renewable sector as well, to the kinds of innovators that are coming up with incremental improvements that optimize the ongoing transition in those sectors, the ongoing kind of replacement of fossil fuels or improvement of renewables operations with more flexibilities and smart technologies, but less of the sort of the broader, as I said, systemic changes, bringing in new designs and tackling some of the harder to abate sectors. And things like long duration energy storage and hydrogen technology did not do as well in 2020 as they did in 2019. And we know we need those types of innovations. When we think again about the fact that we're still in the midst and the depths of a global pandemic and all of the economic consequences that's going to have, can we rely on the R&D being spent, the R&D capital in governments and in corporations, to make sure that the pipeline of innovations is actually still flowing and is available for investors to come in and take those to market. And then the third area in terms of a note of caution is the regional international perspective. Most of the deals are still concentrated in the United States and Europe. Europe did very well in 2020, grew, whereas countries like the US and China actually saw a reduction. But in India, when we look at the share of energy as in terms of the total venture capital ecosystem across the whole economy, energy only represents 3% of the total deals. And what we know is that innovations are going to be able to meet our future energy needs if they are dealing with the contexts that are appropriate to the countries where the demand is going to grow the most. Things like 2-3 wheelers being electrified in places like India, other emerging markets, smart grids that are suitable for those contexts, cooling solutions, other things that are appropriate are going to be vitally important and need to be shared across the borders. So we think that there's a need to make sure that there's no dent in this momentum in the long term, that we keep these levels of investment well above the current levels, in order to make sure that the technologies that we need are available for companies and for governments to put in place the policies and the investment strategies. And that's going to be requiring, we think, a shift from some of the non-sector specific packages that governments put in place last year in order to tackle the COVID-19 crisis, where there was generic support for startups. I know that India supported startups that were particularly focused on solving some of the health challenges themselves, but things more like the Techtonic challenge itself, which is directed towards the clean energy needs that we have and that we can all identify and focus on in particular. And so that's why we're very excited to be a knowledge partner on this challenge, and very, very keen to hear what the investors' perspective is going to be in this panel. And I congratulate everybody